Hey, what's going on, everybody? This is Trent, the retirement planning coach, and welcome to this video. In this video, I am going to cover some new retirement best practices, and specifically when you are trying to model different returns within new retirement, and in my opinion, how you might want to think about what numbers you plug in for forecasting your returns within new retirement. If you're new to this channel, my name is Trent Grzegorczyk. I'm also known as the retirement planning coach, and I help individuals and families, pre-retirees, DIY investors across the country secure their retirement fast. And I do that through retirement coaching in my retirement planning community. It's called the Retirement Planning Club. If that's interesting to you, or if you find value in my videos, you might want to consider checking out the community. Links below in the description, or you can go to secureyourretirementnow.com/RPC. All right, enough of that. Okay, so let's dive into this video. In this video, what you'll want to do is if you use New Retirement and you have an account set up, I'm assuming if you're watching this video, you're either considering using New Retirement or you have already started to use New Retirement. And once you go through the onboarding process and you go to your accounts and assets, and let's just go over to savings, and let's just click on my IRA here. You have the choice to plug in an optimistic rate of return and a pessimistic rate of return. Now, you can really plug in anything, but the problem is you probably should plug in numbers that actually make sense based on how you're currently invested and what your current asset allocation is, right? So what I will do is show you a tool that I like to use to grab what an optimistic number you could use for an optimistic number, and also what you could potentially use for a pessimistic number. There's many ways to kind of break this down and input different percents, but this is just one way. Okay, this isn't the only way, but this is just one way in my mind that makes sense based on how I think about forecasting returns. And let me turn my light on so I'm not so dark. Just bear with me a second. It's just a little dark. Tech issues. Okay. Okay, that's better. Okay, so what you're going to want to do is go to Portfolio Visualizer. All right, so if you go to portfoliovisualizer.com and go to the Tool tab up here and go to Backtest Asset Allocation. All right, so that's what we're going to do. We're going to backtest an asset allocation to see, historically speaking, what the returns have been for a specific asset allocation. You might be asking, well, what does that mean? Stocks to bonds and any other asset classes that you own within your retirement accounts and investment portfolio. Okay, so just to keep this simple, you don't need to change any variables. You actually just want to leave this as is. Dollar amount, it doesn't matter. We're just doing this based off of historical returns. Has nothing to do with dollar amounts in this video. Cash flow, you can just leave that as is. Rebalancing annually is fine. We're not leveraging. Benchmark, we don't need that. Okay, so what we're going to do is just go to, let's just say that you have a 60% stock, 40% bond portfolio. We're just going to plug in 60% stocks, and then we're going to go down to the total US bond market for the 40% bonds. And all we're doing here is just saying, based off of historical performance, what has a 60-40 portfolio, how has that performed over the last several decades? So what we'll do is just calculate that by clicking run. And if you go to the compound average growth rate, you can see here it's 8.76. Okay, so 8.76 you can essentially say has been the return average for a 60-40 portfolio, back tested all the way through 1986-87. All right, so from 1987, that's as far back as this asset allocation using Portfolio visualizer goes back, that's a long enough time frame to really get an idea of how a specific asset allocation could perform. Potentially, nobody knows exactly if it's going to be, 8, 9, 10, 4% over the next 40 years. But this gives you a good starting point. Okay, so by running this, you have a starting point to then say, okay, 8.76, I could use that as the optimistic rate of return. All right, so you could literally just plug in the 8%. But one thing that I recommend you do, if you use personal capital as well, so if you use NewRetirement for some planning features and you use personal capital for some other planning features, they kind of both have like pretty good features, but you kind of have to use both if you're a DIY retirement planner. What personal capital does is they actually take the historical return and then reduce it by 1%. And the reason that they do that is to just provide kind of a cushion of room for error in planning and the potential for lower returns, or maybe even including an advisory fee if you have a financial advisor. It's kind of like, if we experience lower returns, if I have some advisor fees, if there's some variance, at least you're erring on the side of caution. So what you don't typically want to do when you're plugging in a rate of return is be too optimistic, especially when you're really trying to err on the side of caution. Okay, but what you could do in this situation is use this 8.76. You could minus 1%, so 7.76 is what you could plug in here. And as far as the pessimistic rate of return, that can be, you can think about that in a few different ways. Okay. Some people will plug in whatever inflation is at any given time, or worst case scenario, the portfolio just keeps up with inflation. Another way to think about this number is also using Portfolio Visualizer. So what you can do is go to the Monte Carlo simulation, and we're literally going to be running the same sort of instead of back testing, we're going to be using historical data and running a Monte Carlo, which is randomizing events and probability of different returns into the future. Okay. And so what we're going to do is we're just going to keep the dollar amounts the same. You don't need to have any contributions or withdrawals. All we want are just like returns. With this, we can do 20 years is fine. Pre-tax returns, historical returns is totally fine. And we don't need to make any changes here. Bootstrap, inflation, rebalancing annually. Perfect. Okay, so US stock market, we can just do 60%. And the bond market, we can do the same 40%. Again, this is under the Monte Carlo tool. So this is 40%, run. And you'll see here that the 50th percentile, which is, you could say, is the median, is a little bit higher than the other forecast of 8.76%. Typically, they'll be fairly close, but again, these are just like these will change as you run different scenarios and tests. Okay, so based on this one test that we ran, the 50th percentile is essentially saying, like, look, based on the 60% stocks, 40% bonds, 50% of the scenarios are going to essentially average 9.37%. Now, I would not say that that's a smart starting point. Okay. I would actually lean towards the 8.76%, reduce it by 1, and maybe plan for that moving forward on a 60-40 portfolio, as opposed to choosing this 50th percentile. It seems a little bit high. If you're going to, so back to my point of running this, the 10th percentile is what you want to focus on for what I would say is the worst case scenario, or the pessimistic rate of return. So the pessimistic rate of return is essentially saying, like, if we experience like way lower returns than we're assuming that we're going to achieve over a long period of time. You also want to know that and how your retirement plan could be impacted if that's true. What you can do is the same method is what I just showed you. Take the 10th percentile, so that's the worst case scenarios in this Monte Carlo report. So 6.16% minus 1%, so that's 5.16%. And so 5.16%. And now you have an optimistic, which actually I would say is, fairly solid rate of return, given a 60-40 portfolio. Solid rate of return to plan for over a long period of time. And now you have a pessimistic rate of return with reason and with logic, right? So as opposed to just plugging in random rate of return numbers that you're just guessing, or you really, if you're not sure what to plug into these boxes, this is just one way that you can take historical data and Monte Carlo simulations based on specific asset allocations that's close to your specific asset allocation, and actually grab like good numbers to then plug into the new retirement program. All right. And again, so just to like kind of recap, what the first thing that you want to do is you want to use the back test asset allocation, and you want to kind of go through and plug in your asset allocation. Again, 60-40, 60% stocks, 40% bonds. Let's go to 60-40, run it. 8.76% is the historical average over time. Adjusted with inflation is 5.84. But if you're using a platform, a planning platform, you can, inflation is taken into consideration within at least new retirement. You can go in and modify what your inflation rate is going to be. So that's essentially being reduced within this platform. So you don't have to worry about plugging in that inflation adjusted number. So that's how you grab the 7.76 is you take the 8.76, just reduce it by 1% to err on the side of caution. And then what you're going to do is you're going to use the Monte Carlo simulation, keeping everything the same. You can do 30 years. You don't need to withdraw anything, again, because we just want raw return numbers. We don't want, if we were taking out or contributing to the portfolio, skewing the return numbers. We just want what will this portfolio potentially do over a long period of time. Again, we're going to do 60-40. I should have just saved this. It's just wasting time. 60-40. Run it. It's going to be lower because I just stretched out the time frame. 9.31%, a little bit lower than last time. But again, this is kind of high. I would actually plan, if you're going to use this, definitely reduce it by 1. This seems just a little bit high today. Typically, I don't remember 60-40 forecasted over a 30-year period being this high. But anyway, what you want to do is take the 10th percentile here. You could subtract 1 or maybe even 2% if you want to err on the side of caution. So then at least you have some sort of like foundation and baseline that you're basing this assumption off of, as opposed to just plugging in some random number. Okay. And then the next step is to run your plan, run the different either optimistic, pessimistic, or a average of both. So under the assumptions, you can change whether you want to run your plan based on the optimistic numbers, based on the pessimistic numbers, or based on the average of each, which actually is pretty smart. If you want to run your plan based on the average of the optimistic and pessimistic, it'll just average it out. Okay. So if you are using NewRetirement and you're just kind of thinking about what numbers to plug into your accounts as far as the different rates of return, this is just one method that I'm I think is a solid way to have a foundation and baseline of a rate of return to base this off of. Again, you can do this many different ways. You can use the Monte Carlo, you can use the back testing that I just showed you in this specific situation. So there's different ways to, and the time frames and time horizons that you use up here will alter the returns as well. So whether you choose 30 years, 20 years, 25 years, 15 years, or 40 years, it's going to modify the numbers slightly. So over 40 years, it modified it just a little bit. But you get the point. You have a baseline. Use that baseline, reduce it by 1 or 2%, and then you can plug that number in as a erring on the side of caution number for each of these. All right. So that's it for this video. I hope this was helpful. I hope this method of determining based on your specific investment asset allocation for your retirement accounts and investment portfolios, what you would plug in here if you were using your retirement. All right. If you have any questions or if you need some support, just join our retirement planning club. I offer free coaching sessions for 14 days if you join as a retirement planning club member. So go to the link below or go to secureyourretirementnow.com/RPC. All right. secureyourretirementnow.com/RPC. And then you can just start your free trial, get coaching from me. Also within the membership site in the retirement planning club, there is a DIY retirement planning course. So once you enroll and start your free 14-day trial, you literally get access to my DIY retirement planning course that has 50 plus step-by-step DIY retirement planning video trainings, just like I'm taking you through here, only in much greater detail and step-by-step, not skimming over anything. Okay. So if you are a DIY investor wanting to become a better planner, if you are recently forced into retirement, you're thinking about retiring in the near future, and you just want to get started with a very, very low barrier of entry and very low, I would say, there aren't any hurdles to jump over. It's literally like you can get started today, no strings attached, for 14 days free. It's just a great way to dive in, start your planning, and then if you feel like it's a good longer term fit for you to stay as a member of the retirement planning club, cool. If not, that's totally fine too. I get it. All right. So go to the link below if you want to expedite your journey of being a DIY retirement planner, or just building a better retirement plan. Even if you have an advisor, we have people who are joining the community who have a financial advisor, but they don't really focus on comprehensive planning. They focus on investment management, which is fine, but they're looking for more of a comprehensive planning first, education first value, and that's what the Retirement Planning Club offers. All right. So more details in the link, or go to secureyourretirementnow.com/RPC. That's it for this video. Take care. Have a great holiday weekend, and I will see you hopefully next week. I'm on vacation next week, so maybe I'll post one video while I'm on vacation. All right. Take care, guys. Bye.